Hey there, investors. This week we looked at 9 of the retail building supply companies. You know, those folks like Home Depot and Lowe's and Lumber Liquidators. Well, only 4 of them made our list. You see them here. Let's go dive in and see what we can learn about them. Please remember to hit the like and subscribe button. Hit that bell so you don't miss an episode. And tell all your friends about this channel so they can join in the conversation. We are diving right in with Fastenal Company, ticker FAST. Their dividend yield is 2.7%. That is filled with gold because it's greater than the 2.6% that we use for our benchmark. That's on $32.35 as of the 21st of June. If you've been following Fastenal, you know that they did a 2-for-1 split in May. So their price is down in the area of retail investor interest again. They are not qualified for cash flow per share or earnings per share, but they are a Div 0, 17 years of increasing dividends per share. Here's what that looks like on the long-term trend. You can see that dividend per share line moving up at a pretty decent slope, and the cash flow and earnings a little bit jagged, but also a good upward slope. On the year-to-year trends, you can see that the dividends per share are always above the zero line. And you can see here you've got earnings and cash flow negative. Here was a flat year for cash flow and a negative earnings. All right, Lowe's, you've seen their stores all around the towns. Their yield is 2.3%. That's on $96.35. They are not qualified for cash flow or for earnings per share, but they are a Div 0. 17 years of increasing dividends per share. Here's what their year-to-year trend lines look like. The dividends per share, not a great upward slope, but it's pretty smooth. The earnings and cash flow took a hit, when the housing market busted, but it's been coming back strong ever since. Here's what they look like on the year-to-year changes. All right, Sherwin-Williams, the paint people, their yield is 1.0%, and that's on $470.87. Sorry, that is out of my league. But they are a cash flow 1. So 17 years of increasing cash flow per share. With the exception of this one down year here in 07 to 08, we do allow a down year or negative year in the cash flow. And they are a Div 0, 17 years of increasing dividends per share. Here's what they look like on the long-term trend. Now that dividend per share line is nothing to get terribly excited about, but boy howdy, look at those cash flow and earnings numbers. Here's the year-to-year changes. Again, cash flow and earnings looking pretty good in those later years. Dividends, nothing to really get all excited about. All right, Tractor Supply Company, you may or may not even know about these folks depending upon where you live or what you pay attention to. Kind of a cool store. I like going there sometimes. Tractor Supply TSCO, their yield is 1.3%. And that's on a price of $107.33 a share. They are qualified as a cash flow 0, 17 years of increasing cash flow per share, and qualified as an E1, so 17 years of increasing earnings per share, with the exception of one negative here in the 07 to 08 time frame. They are not qualified for dividends per share, but take a look at this. The reason is they didn't pay dividends for a long time. They started here in 2010, and once they started paying dividends, they've been positive, increasing every year since. All right, here's what they look like on the long-term trend. And here's their year-to-year. All right, let's get them all stacked up against each other, see how they play out. First, just a quick summary on who's qualified for what. Fastenal qualified as a Div 0. Lowe's qualified as a Div 0. Sherwin-Williams qualified as a cash flow 1 and a div 0, and Tractor Supply qualified as a cash flow 0 and an earnings 1 but not qualified for dividends. Here's what they look like next to each other. I'm trying a little different flavor for the charts here, so let me know if you like the way this looks or if there's any other changes you'd like me to make to this. You can see that Sherwin-Williams is outperforming the other three quite substantially in the cash flow per share. And at the bottom of the stack is Fastenal. Earnings per share, again, Sherwin-Williams outperforming and Fastenal down at the bottom of the pile. Probably no surprise there that these curves look a lot like each other. All right, and here's the dividends per share. So Sherwin-Williams is outperforming on the dollar value of their dividends per share, but that's only a 1% dividend yield. Of course, it's on $470 a share, so it's a pretty good chunk of money. Tractor Supply and Lowe's in the middle here, and Fastenal down at the bottom, but Fastenal is the highest yield at 2.7%. So kind of an interesting way to see the way this plays out. The company with the absolute lowest dividend yield as a percentage is actually paying more money because of the value of the stock. The company that's giving you the best dividend yield is the company that is got the lowest value on the dollar per yield. So I'd like to know what you all think about these companies. If you own any of them, why you own them, why you might be thinking about them. Are you going to put some retail building supply companies into your portfolio, and did this help you with your decision at all? I look forward to your comments down below. Have a great week.